Donald Trump just lifted the tariffs with China. So now the total economy is okay, right? Not so fast, my friend. There is a lot of economic signals signaling that we haven't escaped just yet. But nobody is talking about this big data point about credit card debt in the United States. The Federal Reserve's campaign to raise interest rates to bring down inflation also affects credit card debt, as some economists say it's fueling economic inequality. Although the Fed paused rates last year, they are still fairly high and influence credit card rates. So if we look at just household debt, it's hit a whopping $18.2 trillion, and student loan delinquencies have now jumped and rised up more than anybody initially expected. So the total debt balance, now look at this thing. These are charts you don't like to necessarily see rising up and to the right, but it continues to see that. We're seeing housing debt not necessarily going up as much as the non-housing debt, which seems to be raising and raising and raising. And the non-housing debt is interesting, right? Because all right, you're looking at mortgage balances. They grew by 199 billion in the first quarter and totaled 12.8 trillion by the end of March. But it's elevated because of the gap of mortgage balances. Balances on home equity line of credits rose by $6 billion. So for those of you guys who don't know, a HELOC, home equity line of credit, is essentially just pulling some money out of that house that you've been paying down for quite some time. So people are taking money out of their houses. The 12th consecutive quarterly increase, which is very interesting. Now, 402 billion outstanding in HELOC balances, 85 billion above the low reached in the first quarter of 2022. Credit card balances now total 1.18 trillion outstanding. It fell by 29 billion in the first quarter and are now 6% above the level a year ago. But we're also seeing auto loan balances decline by $13 billion and now stand at 1.64 trillion. Only the second time since 2011 that auto loan balances have dropped from one quarter to the next. So encouraging signs in some aspects, but it seems like mortgage delinquencies and the amount of the big dollar assets that the general population has are rapidly increasing. So everybody's been selling you the American dream, right? What is the American dream? The white picket fence, own your own house, do that whole thing, right? Well, not so fast, because now everybody's taking all the debt away from their largest purchase that they've ever made. And so now there's payments are increasing, and soon enough, how a home equity line of credit works is, generally speaking, you get 10 years of interest only payments. And then the second 10, you got to start to pay that down. So you could get a big balance coming out of interest only payments. And then 10 years later, you got to hope that you're figuring out or have the time to figure it all out. So it's going to be interesting to see how this plays out. But that is something that I think is super alarming and that people should be keeping a close eye on. Credit card debt in the U.S. is increasing. The total credit card debt has increased by 1.2 trillion in the fourth quarter of 24. It is partially due to the impact of inflation, increased interest rates, and a continued push for revenge spending. Come on, revenge spending, just like it's all the tariffs, right? But I think what we're looking at is a very interesting aspect here. We're seeing household debt balances continue to steadily increase. Delinquency and transition rates remain elevated for auto and credit cards. So we're starting to see the pace of mortgage originations increase slightly from the past 4 quarters, with 465 billion of originated mortgages in Q4. but the aggregate limits of credit card accounts increased moderately by 98 billion. So the limits on HELOCs continue to rise as well, as we saw an 8 billion increase. But this is the big thing, right? We're seeing that delinquency rate rise up to 3.6% on that, which I think is absolutely massive and cannot be understated. So delinquency and transition rates are held steady for all types of debt, excluding credit cards, which had a small uptick in transitions from current to delinquents and transition into serious delinquency. So it's defined as 90 or more days past due, edged up from auto loans and the HELOC balances, but remain stable mortgages. So look at all these changes. We're seeing everything go up, up, up. Total debt just keeps on rising and ticking up. But let's look at the overall global economic features. It's not all debt, folks. That's the real honest truth here. There's a lot of economic signals that are not really showing the strongest signals here, especially, when had everybody blaming all the tariffs. Well, now the tariffs are gone. So the economy should be just peaches and daisies, right? No, it doesn't seem like that's the case. We're not out of it just yet. Global economic outlook, mixed signals, and recession has feared, right? Because the commodity market, oh wow, now they want to show me this now during all of this, but the commodity markets have shown a slowdown. Commodities, oil, copper, signal slowdown in growth. Oil prices decreased 16% this year, and copper prices, although recovering from recent lows, remain below their March peak. This aligns with analysts' views of weaker demand due to the global economic deceleration. Bond markets. Bond markets show concerns over a slowdown triggered by US tariffs. Obviously, that's done with, but we're going to get into the yields here in a second. And then stock market optimism. We do have the stock market actually doing pretty well. And then we've got, of course, jobless claims, which I've gone over on a few of these live streams, how I feel like the jobs data is basically not showing the whole truth at this point, because you'll see that the jobless claims and unemployment rate is not increasing, which is actually very encouraging. But on the flip side, the negative of all of it is that, hey, if you look at it underneath the hood, nobody is hiring. You're seeing a lot of limited aspects when it comes to, the overall movement of jobs. People aren't going that way. Consumer confidence is hitting is hitting a low that it hasn't seen in years. And so the consumer is afraid that if I lose my job, I'm not going to be able to find another job anytime soon. And then we're also seeing just a various other things at this point. So I think that it's, something that we can continue to see here quickly change. But the data that we're being shown and told is something that I think is being manipulated, and being manipulated in a sense to show that we don't necessarily need, these things to be all completely uncovered, so to speak. So if you look at the week ending on May 3rd, and U.S. initial jobless claims were 228,000, a decrease from the previous week, and the 4-moving average. So we're seeing a decrease in these jobless claims, but continuing claims also decrease, falling by 29,000 to 1.879 million. This ensured the unemployment rate dropped to 0.1% percentage points to 1.2%. And their insured unemployment risk. So we're seeing a lot of that, right? But, we're also seeing the leading economic index fall in early April. This has declined by 0.7% after a decline of 0.2% in February. So it's been falling down every single month this year. So the yield curve has essentially inverted as well, which, if you see that, everybody says, we're basically, everything's all over, that what we're seeing right now is potentially game over because that's what everybody's saying. Hey, you're seeing these yield curve reversions, FinTwits yelling from the top, panic now, essentially. But in reality, the situation, if you look at the strength of the dollar, how it's pumping up right now, all pumping up comparatively to when I started doing these live streams, it was sitting at 98, 99. Now we're over 100, just under that 101 mark. We had a slight decline just recently. I think it's after market close. We've seen a 0.15% close down to 100.82, which shows that the dollar is still pretty strong, even though we still have inflation running somewhat high. Because we have inflation running high, the Fed has decided, hey, we're probably more than likely than not going to cut interest rates next year or next month, excuse me. And there's an 8.3% chance that we're not going to do that, or that we are going to that. Excuse me, man. I'm all over the place here coming to you guys late night here, but an 8.3% chance that the Fed cuts interest rates at the next meeting. So it seems like the Fed is looking at what we're seeing, right? The market is showing some strength. We've seen, the stock market be fairly resistant. We're seeing the 5-day change here of all of this, and we're going to start to see this start to push along. And I think, with with this past month and with the tariffs change, we're going to start to see some more strength coming back into the economy, some more confidence. Now, I don't think the average consumer who is maybe looking at the jobless claims or something else is saying, hey, I'm worried about the Trump tariffs. I'm worried about all these different things. I don't think that this is the same thing. And All Nighter Hider saying, didn't I just hear George talking about something similar? You did, because I think George is nailing it on the head. The burden keeps getting bigger on what we are seeing here, right? But I think, one thing that George what didn't show was this chart here, the amount of debt balance that we're seeing between the two. He was talking about the mortgages and all that, but the credit card debt and the delinquencies are rapidly increasing as well. So smoke that like Cheech and Chong, as the GOAT All Nighter Hider is saying in the chat. I appreciate you guys coming in. Please hit that subscribe button for me, because I'm going to be detailing how the consumer has been showing cracks, for quite some time when it comes to the overall economy. We haven't really seen too many of big signs from anybody but the consumer. The consumer confidence has been extremely low. The jobless claims haven't really skyrocketed just yet, but the consumer confidence is essentially showing that, hey, if I lose my job, I'm not confident that I'm going to get another one here in the near future. And then on top of that, we're also seeing credit card debt rise up. So as the GOAT is saying, smoke the like Cheech and Chong, hit the subscribe button, tell a friend to tell a friend, and I'll catch you guys all tomorrow.